Assalamu alaikum. Ahmed here from Nisba, where we explain how to invest in a Sharia compliant way. And today we're going to break it down. We're going to keep it super simple. Have you ever wondered how people go about investing into companies like Apple or Tesla or Tesco? How do people do that stuff? What are they even doing? How does it all work? What are these things called shares that people talk about? And how can I start doing it? That is what today's video is all about. And I'm going to try and keep it as simple as possible. The problem with that is there's a problem. Because I've been working in the investing and finance industry for like 13, 14 years, and I'm a chartered financial analyst and I have a diploma in regulated financial planning, and I went to university and studied finance. You can see what I'm trying to do. I'm trying to kind of qualify myself that I'm allowed to talk about this stuff. But regardless, what I'm trying to say is sometimes it's more difficult to teach stuff after you've known it for a long time, because you just think, oh, of course everyone understands this word market cap. I don't have to explain that. But in reality, you do, because a lot of people don't understand terminology, and it's just things that people get used to after they've been working in the industry for such a long time. So where can we begin? Let's start with a super simple definition. Shares, equities, stocks. When people say these words, when people use this terminology, usually they're talking about exactly the same thing. A small part or a part of a business that you can own. Typically a tiny small part, but yes, you can buy into a business and then you own a share of that business. You own part of the equity of that business. Now let's take that to a simple example. You go out of your house, you go to your local high street, and there may be a pizza shop. I'm not thinking your Domino's, I'm thinking your average small pizza shop that only delivers locally. Now, if you wanted to, in theory, buy into that business, what you could do is you can go and speak to the owner and say, hey there, Mr. Khan, I see you have this pizza shop. I would like to buy a part of the ownership from you so we can share in the profits and losses and the ups and downs of this business together. And he would say, okay or no. And then what you'd have to do is there'd have to be a transfer of ownership of the shares within that company from him to you. And they'd have to file that in with Companies House. And he would decide how much he's going to charge you for that portion of the business that you're going to buy. Now, if you wanted to, in theory, what you could do is you could buy all the shares. So you could tell Mr. Khan, I want to buy all of the shares of the pizza shop and buy your whole company. Then you'd be the new complete owner. And that's, in essence, what equities, shares, stocks are. You are buying into companies. But how does it work with these other companies like Tesco, like Vodafone, Apple, Tesla, Microsoft? How does it work with those companies? Because there's no Mr. Khan to speak to at the local shop. No, it works in an entirely different way. Typically, when companies become very large, we're talking millions of pounds in revenue, hundreds of employees, if not thousands, making lots of money, making profits. Not that they have to be, but generally this is the life cycle they go on. They may want to start selling shares. They may want to start selling parts of the company, because the owner of that business will now have a business that is worth a lot of money. So much money, in fact, that it may not be feasible to sell it to one individual person or one individual other company. They may want to sell it to the public. So anyone can buy it. And the first time a company is offered out to the public, that process is called an initial public offering. So almost every company out there that you can buy their shares of at some point would have had an initial public offering where the shares are offered out to the public, and then you can choose to buy it or not. After that initial public offering has completed and all the shares have been allocated, then the shares can begin to trade. So unlike in our example earlier where you were buying into the shares of a single shop, realistically, not a lot of people know that shop. Not many people may be interested in buying shares of that shop. However, large companies like Apple, where the company is worth so much, lots of people may want to buy shares in that company. So when the shares are sold for the first time, they get listed onto an exchange, and on that exchange, people can buy and sell shares between themselves. So when you are buying shares of Apple, Typically, you're buying it off someone who already holds it. And when you are selling your shares of Apple, you're selling it to someone else who wants to hold those shares. Now, if you were to go out there and continuously buy the shares of Apple stock and you had millions and billions of pounds, in fact, you'd need trillions of pounds, you could, in theory, buy the entirety of Apple and then you would be the sole owner. And then you could do whatever you wanted. You could rename the whole company from Apple to whatever your name is if you wanted. So after these shares are placed on an exchange, you need a way to access the exchange in order to buy the shares if you wanted to buy them. And why would you even want to buy them? And how do you access these exchanges as a person? And here's a big one. Is it even halal? Well, there are companies out there that have access to exchanges and then offer that service to you so you can access buying the shares on the exchange via them. And they are called brokers, or you might know them as investment platforms. A very popular one these days is Trading 212. However, there are loads out there. The reason why Trading 212 is quite popular these days, and let me just pull it up. Trading 212 is quite popular these days because it doesn't have very high transaction costs when you want to buy shares on an exchange. Now, when you load up a platform like Trading 212, they don't just have shares, equities. They have a few different other things which can make it quite confusing. Like when we load up the Trading 212 page here, the first thing you're presented to is this thing called USA Tech 100. That's not an individual share. In fact, it's a grouping of 100 different shares in the tech space that are in the US, hence the name USA Tech 100. So these things are funds, but we're not getting into funds on this video. What we're talking about is individual shares, like Nvidia, like Tesla, like Apple. Gold is not a company, it's not an equity, it's not a share. It's just another thing that's listed here on Trading 212. We have things like Microsoft, Amazon, Google, Facebook, JP Morgan, Coca-Cola, and there's going to be loads of these companies. Here, you can buy into Royce shares using the Trading 212 platform by just clicking on buy. You select how much you want to purchase, as long as you have the right amount of money in the account. You review the order, you go through, and that's it. You are now the new owner of the shares in Rolls-Royce, and you can call yourself a part owner of the Rolls-Royce company. So next time you walk into that Rolls-Royce dealership and they don't treat you very nicely, that's when you say to them, "Excuse me, sir, did you know I am a part owner of this company?" At that point, they might treat you much nicer. However, in reality, if you were to buy one share, which costs 943p as of the moment, which is £9.43, you would own such a small, tiny, minute part of the company, no one would ever really care. What you'd have to do is you'd have to keep buying shares of Rolls-Royce to the point that you own a significant amount, and that's when people generally start caring. Now, this number here, 943 pence, which is the price of the Rolls-Royce shares, doesn't actually tell you how much the company is worth. This number is arbitrary, so it doesn't mean anything without knowing how many shares the company has outstanding. Because Rolls-Royce could have just one share outstanding, i.e. the company only issued one share ever in its lifetime. That would mean the whole company would be worth £9.43, which is obviously not right. Companies can issue as many or as little shares as they want. If they only ever issued, let's say, 10 shares, each share might be worth like £7 billion, which is completely ridiculous because then nobody could afford to buy one. And in fact, as a company grows or shrinks, the company can actually increase or decrease the amount of shares it has outstanding. But then we're getting into a slightly more technical part of stock trading and stock ownership, and it doesn't really matter as a beginner. So if the actual price doesn't tell us much about the value of Rolls-Royce, how do we know how much the company is actually worth? Well, what number you're going to be looking for here is the market capitalization, also known as the market cap. And very simply, it's the number of shares they have outstanding multiplied by the share price. And if we scroll down on most trading applications, such as this one or Trading 212, it will have a field which will be nicely hidden behind my head at the moment. So let me just move myself out of the way. It will have a field, and you can see here it says market cap, market capitalization. And if you read over to the right, it says £73.27 billion. So that's how much this company is worth, £73 billion. It is not worth just £9.43 or 943 pence. And we can see the same thing with any company like Coca-Cola. Coca-Cola, the stock price of one share is $71 or $70.92, but the market capitalization is down here, $305 billion. So we can say that roughly speaking, if the price of Rolls-Royce was in dollars, but it's not, it's in pounds, but let's say Rolls-Royce is worth $70 billion and Coca-Cola is worth $300 billion, then Coca-Cola is worth 3 times as much as Rolls-Royce. You can't compare this stock price to the stock price of Rolls-Royce because that doesn't make any sense. It doesn't take into account how many shares are actually outstanding. So why would you even want to own these shares? What's the whole point of it? Well, over time, companies generally are in the business of making money and growing themselves. And if they're in that business and they have lots of people working towards that goal, then why would you not want to own a piece of that business which tries in different ways to make money for itself? And when it's making money for itself, if you were an owner, you'd be making money for yourself. So if we just look again here at the chart of Coca-Cola, we go for a longer term view. Here, the stock price, the stock chart only goes back to Feb 2016. But in Feb 2016, the stock price of Cola was $43. And now it is $71. So over time, the stock value is increasing because the value of the Coca-Cola company is increasing. Now, that's not true for all companies. Not all companies grow in value all the time. Let's look at another example. This here is Facebook. Facebook back in 2017 was worth around $170 per share. And now, as of where we are in 2025, it's worth $700 per share. And we can go even further back actually and look, it was worth $40 per share. And now it's up at $713 per share. What a great increase. Of course, it's not always going to be like that. Some companies do go down in value, and usually they're the type of companies that you'd never have heard of because they never managed to grow to the size that Facebook grew to or to the size that Coca-Cola grew to. They grew a certain way and either stayed there and never became globally famous, or they just got big and then died. You can think of companies like Kodak, Blockbuster. For our American audience, companies like Sears, Woolworths. I don't know if Woolworths is around anymore, but there are so many companies that grew to a very large size and then slowly disappeared into irrelevance. So yes, the great part of owning shares is that some increase in value over time. Some companies, even after making profits, they can pay out those profits to you as dividends. So just for holding the share, you may receive periodic payments, be it quarterly, semi-annually, or annually from the company. It won't be a huge amount. So if you hold £100 worth of a company, they may give you every year, let's say £5, so 5% of your value, maybe more, maybe less. Not every company pays out dividends, but some companies do. So that's a great reason to hold stocks because you may get that dividend. You also get the stock price increasing over time. Sometimes, again, it doesn't happen all the time. And what's really good to remember is that not all companies have the same amount of risk. A company which is very large and established, you can imagine, is a lot less risky than a company who's just invented some new technology which may or may not work. So not only does it depend on the size of the company or the maturity of the company, but also the industry that the company is in. When you're investing into companies, a company doesn't really change its situation in a week or a few days. So it doesn't typically make sense when investing to hold companies for such a short period of time. What's nice to do is when you see a company and you think it will do well, to hold it for a very long period of time, 5, 6, 7, 10 years plus, to see that company grow. That's when you can start to make the real returns when you invest into companies. But what about the halal versus haram aspect? Is every company halal to invest into? No, it's not. There are a few things to look at. Things like, what sector is the company in? Is the company in a sector which is not really in line with the rules of Islam, such as gambling, alcohol, tobacco, financial institutions, insurance, things like that? They're not going to be okay. But that's not it. A company, even if it's in the right industry, like Coca-Cola, we're going to have 2 other issues here. We're going to have one, are the financial ratios good enough for it to be considered Sharia compliant? Does it have too much debt on its balance sheet? Does it receive too much income from impermissible sources? Here it becomes quite technical, and that's when you have to start checking out online different websites that do the Sharia screening for you to actually find out if a company is halal before you can invest into it. And of course, there's a third thing that you have to think about, apart from the industry, the financial ratios, is ethically speaking, do you think the company is okay to invest into? Even though currently the Sharia rules don't cover the idea of is a company ethical or not to invest into, a lot of the companies out there today aren't supporting Muslims in different areas of the world, and they're probably not the type of companies that you want to be invested into. So I hope that was useful. We cover things like what is a share? How do you buy one? What's an IPO? What does market cap mean? What does a stock price mean? How can you tell if a stock is halal or haram? This topic goes very deep and you can go through it for hours and hours. One thing you might want to think about is it even necessary to learn that much about investing or individual stocks when you do it? Because some would argue that even the people with a lot of knowledge about how to invest and how to analyze stocks still don't do a good job of it. Now, we're going to be putting out more content like this, which breaks down quite complex topics in investing in a very simple way, and also talking about what parts of it are halal and what parts of it are not. If you like what we do, make sure to give us a follow. Assalamu alaikum. I'll see you next time, inshallah.